Good morning, everyone. Today is Tuesday, November the 23rd. Welcome to the Multnomah County Board of Commissioners. We're having an informational board briefing this morning. The health and safety of our community and staff members are at the forefront of our minds as we continue to navigate county business in light of the COVID-19 pandemic. In accordance with the declaration of emergency, some board rules have been temporarily altered. Today's meeting is a hybrid board meeting. Some presenters and guests will appear in person and some will appear virtually. For those who are presenting virtually, please mute your mic when you are not speaking. And when you present, make sure that your mic is unmuted and your camera is on. For those appearing in person, please wear your face covering while in the building at all times. And if you're presenting, please state your name before responding to questions for those listening remotely. Today's briefing is on the FY 2023 General Fund 5-year update. Good morning.
Good morning, Chair. Christian Elkin, Budget Director, here with Jeff Renfro, our economist, to provide the first step in our fiscal year 2023 budget process, which is to tell you how much funding we think will be available over the next 5 years. Just to set the tone, the fiscal year 2023 budget will be particularly complex in light of 3 new funding streams that we implemented in fiscal year 2022, the Metro Supportive Housing Services Measure, Preschool for All, and the Multnomah County Library General Obligation Bond. A need to consider priorities and allocations for the second half of the county's American Rescue Plan funds, and our continuing efforts to integrate and embed equity practice and analysis into the budget. Our key dates for this process are going to change, anticipating that this will be a very complex budget. So traditionally, the forecast comes in the beginning of November. We pushed that date back due to the need to do our business income tax process that we finished up last week. On December 10th, we will have what we call the big release, where we set the departments in motion with the budget manual, their personnel costs, their internal service rates, and all the technical pieces they need to complete their budget. On December 15th, we will have our budget kickoff. It will be hosted virtually again this year. Last year, we had over 200 participants attend, which was probably the most exciting budget kickoff we've ever had. And as of now, we have attendees of over 250 attendees. So we're very excited. And the chair, again, will make a guest appearance. And so we're our Office of Diversity and Equity. This year, we're also pushing back the department's due date for their budgets. Traditionally has been right around Valentine's Day, and I like to joke that it is a little gift to the budget office. We're going to push that back by 1 week to really acknowledge the complexity of the work that the departments are doing, which then in turn kind of pushes back all of our dates by about 1 week. We anticipate posting the program offers online on March 4th. On April 28th, the chair will release her FY23 proposed budget. And then if all goes well, we will adopt the budget on June 9th this year. So now I'd like to turn it over to Jeff to provide the 5-year forecast to set the tone and the stage for the fiscal year 23 budget.
Good morning. For the record, I'm Jeff Renfro from the Budget Office. It's great to be back doing this in person. So do we want to bring the slides up? All right, and if we want to just advance to the next one. So it's going to be a fairly regular agenda today. So our kind of fun economic topics at the beginning, we're going to focus on employment issues just because that's in the news. We'll get into the county's revenues and then talk about the expenditure side of things, and then do kind of our one-time only contingency housekeeping at the end. As always, just stop me at any point. It'll be much easier to do that in person if you have any questions. Next slide, please. So as always, we're going to kind of give away the punchline at the beginning here. So given that fiscal year 2023 will be the first year that we get the really significant revenue bump from urban renewal areas that have defeased their debt and then returned their assessed value to the tax roll, we get a big bump in 23 due to that, along with the fact that even though you all passed the BIT reform way back in February of 2020, because of the recession adjustment that we made, this is the first forecast where this is like fully incorporated into everything that we're doing. So there's another bump associated with that. There is higher inflation in 2023 that we've already incorporated into everything. And then we're also assuming higher than normal inflation in fiscal year 2024. We'll talk about inflation a fair amount toward the end. And then as always, we're going to be talking about COVID-19 still and the continued uncertainty around kind of mitigation strategies, what that means for the economy, and kind of what the path of recovery looks like. So if you want to go to the next slide, please. So since the start of the pandemic, I've always started with this, and it's still appropriate to start with this, that COVID-19 remains the limiting factor in the economy. We're going to be coming back to this several times in kind of several different contexts throughout the presentation. But still kind of future path of recovery in the economy is highly dependent on virus mitigation. I feel like every time we're talking about this, what virus mitigation means sort of changes slightly. So the continued development of that will dictate kind of what is happening in the economy. The recovery has been robust. It's been significantly faster than I think anyone would have expected when the pandemic started, but it continues to be constrained by ongoing labor market issues, which we'll talk about in a second, and then supply chain issues, which I'm sure we've all been reading about in the newspapers. As we know, particularly at Multnomah County, there's continued evidence of a two-tiered recovery, both for households and for businesses. This has implications for the services that the county provides, as well as our BIT revenues. And then there's a tremendous amount of uncertainty that remains in all of this, but the areas that we're going to focus on are inflation, which we've talked about in the past. For us, based on our property tax structure, inflation is really the one issue that there's no managing around that for us. If we get an extended period of high inflation, it's going to be tough to deal with. Federal legislation, specifically around the reconciliation process that's happening right now, depending on both the services that are funded, but then also the way it's paid for has implications for our BIT revenues. And then recovery of urban centers. So downtowns across the country, particularly in the West, continue to struggle and kind of have had a slow recovery. Portland specifically has become sort of the poster child for some of these issues, and we're starting to see that in the economic data. So we're going to come back to sort of Portland-specific challenges here. We'll get to that later, though. So if we want to go to the next slide. So this is based on polling data from the Census Pulse survey. So this is asking people who had been employed before the pandemic started, who remain out of the workforce, why are you out of the workforce? So the red line on the top is I'm out of the workforce because I got laid off and I just don't have a new job yet. That light line near the red line is I remain out because I have to care for my children. The lighter gray line towards the bottom is just concern about the virus, so staying out of the workforce until you feel more comfortable going out more. And then that black line that really takes off in August there is I have COVID or someone I know has COVID. So you see that become a significant factor as the Delta variant takes off. So even as things start to open up, I mean, you see I have to take care of my kids. That reason declines as schools reopen and I think more daycares come back online. But then something to keep in mind is that if we're in a situation as a country where every day we're doing, 6 digits of new COVID cases, even if only half of those people are in the labor force, every day we're taking a significant number of people out for 2 weeks at least. And then all of those people are probably taking an additional person with them to care for them. So when we're talking about labor shortages, this is still really being driven by both concern about COVID, but then also just if we have this many cases, it's going to disrupt everything. If we want to go to the next slide, please. So to kind of illustrate this further, we're just going to focus on one industry and kind of really dig in here. So this is leisure and hospitality employment here in Multnomah County. You can see even after a pretty significant recovery from the pandemic lows that we hit, we're still about 20,000 jobs short in this area, just in Multnomah County. So if we want to go to the next slide. So the Oregon Employment Department about a month ago put out this great report, and they looked at a cohort of people in Oregon who worked in leisure and hospitality in 2018. And then they looked at where those people were a year later. And then they took a cohort of people in this industry in 2020 and looked at where they were a year later. So the green line is our pandemic cohort. The orange lines are our pre-pandemic sort of normal times cohort. So one thing to note here is even in normal times, almost 40% of people who work in leisure and hospitality a year later aren't working in that industry. So there's just a lot of turnover here. That's kind of normal. In the pandemic world, only half of the people who were working in this industry a year ago are still employed here. So where did they go? There's a significant number of people, even pre-pandemic time, found a job in a different industry. But the increase in people who just went to go work somewhere else, even at 2.5%, if that's 2.5% of a relatively large industry, that's a lot of people who just left this particular field. So this is a major factor in explaining why we have labor shortages in this industry. In both samples, about 20% of people just didn't show up again in the Oregon data, so they either moved away or they remained out of the labor force. And then in the post-pandemic world, about 10% of these people are still receiving unemployment claims. So if you take people changing industries or people who remain out of the workforce collecting unemployment, that's a lot of people. So, when you go to a restaurant, you go to a hotel, you see help wanted signs that list every, job in the business. This is why. And this is, I think, pretty significantly driven by COVID concerns. So, a lot of the kind of oxygen in the conversation is taken up by kind of like who's anti-vax or who's not sort of taking this seriously. But I think the polling data has been really clear throughout the pandemic that the vast majority of people have taken this really seriously, and they're changing their behavior, both as kind of economic actors, but kind of what they're willing to go out and do and what they're willing to do for work. And that's causing a lot of these shortfalls. If we want to go to the next slide, please. So moving to a different area, and I know we've talked about this in the past, and I know you all are interested in this specifically. So this shows the unemployment rate by race and ethnicity. So the blue line are Asian people, the black line or the red line is black, the gold line is Hispanic, and the white is the green line. So I think the thing to note here is that, and sorry, this is national numbers. So overall, the unemployment rate has been a positive sign in this. So the unemployment rate, it's important to note, only includes people who are employed or actively looking for work. So it excludes people who remain out of the labor force. So the unemployment rate is almost back to its pre-pandemic levels, which before the pandemic, we were talking about how it was historically low. But then when you dig into the data, there's a significant gap here. So the red line, which I said was black unemployment, if you kind of draw a line all the way across the curve, it's still basically at the level that white unemployment was as we were in the kind of worst of the financial crisis. So the headline number here at the national level really hides a lot of inequity and hides the fact that portions of our community still have a long way to go before we're fully recovered here. I think the bit of good news here is that if you look in kind of the 2018 to 2020 period, there is a shrinking of that gap. If we had the wage data, the sort of racial wage gap, you would also see a shrinking during that period. And the reason for that is really the kind of best thing that seems to solve these issues is, or at least temporarily solve the issues I think we're finding, is a hot labor market, right? So if people are, if there's a lot of need for new employees, you see this gap shrink. So the fact that we continue to have labor shortfalls, that we have a low unemployment rate, I would expect this to shrink over time, but then it's a fragile improvement, it seems like. So the next time we have a recession, we would expect to see it grow wide again. If we want to go to the next slide, please. So this is mostly for reference, but it shows on the left side, it's the unemployment rate in both Oregon and Multnomah County. The right side is just like the gross number of employed people in both areas. And you'll see that relative to the state as a whole, Multnomah County is still well below our pre-pandemic level of employment. A lot of this has to do with the industry makeup of Multnomah County. The kind of leisure and hospitality industry is concentrated here. Yes.
Commissioner Vega-Peterson has a question.
Thank you, Chair. Jeff, thanks for this information. I just have always wondered how much, because when we get the Multnomah unemployment rates, they're not seasonally adjusted, but I just wondered how much seasonal adjustment actually affects or impacts Multnomah County.
Yeah, definitely it does. And oh, sorry, I think I'm supposed to say Jeff Renfro responding to your question. It definitely does, and it has in particular over the last few months because two places where there's really significant seasonal adjustment are as schools reopen in the fall and then around kind of the holiday shopping time. So the expectation is during both of those periods, you get a big bump in employment. So what's happened, at least in September, is that school employment bump just like didn't happen. And, you know, I think it's a combination of factors. One of which is some of the sort of support positions in universities and schools we're just not hiring for, either for financial reasons or because we just can't find the people to do those services. So at least for Multnomah County, I like to report the not seasonally adjusted one because I think, and especially right now, I think the variation I think tells an interesting story. But if you're curious, it would be easy to, I have the data that's already seasonally adjusted. Yeah.
No, I was just curious. Thank you. And I know that, you know, for one thing, but like the teachers, they didn't hire substitute teachers, right? It was really hard finding substitute teachers. So that's one of the things too. So anyway, that's so interesting. Thank you.
All right, if we want to go to the next slide, please. So we're going to move into what this means for Multnomah County, the institution. So this is the changes we're making to the current year forecast. A few of these I'm going to skip over now because we're going to talk about them in more detail. But property taxes were increasing by $5.4 million. The underlying property tax story, I think, is following our expectation. Really, the reason for this bump is the River District URA returned about 2/3 of its AV a year earlier than we were expecting. So we got a little surprised when we saw the tax roll. I'll talk more about property taxes in a second. The business income tax increase of $29.8 million. This is the second part of what we were talking about a month ago. So our collections were higher than expected in 2021. So we have to adjust the current year to get to that level. This higher level of BIT is already incorporated into fiscal year 23 and beyond. U.S. Marshal beds were increasing by a little over $500,000. And this is really in the beginning of the fiscal year. We had a very high rate of usage. It was about 130 beds on average per night. The sheriff's office over a month ago asked the U.S. Marshals to reduce their usage, which they have. So we expect it to be at about 95 for the rest of the year. But because we had such a big bump, we're just incorporating that into our expectation. The video lottery adjustment, I distinctly remember at the beginning of the pandemic saying, I don't think that people want to sit next to each other and play video lottery. I was completely wrong about that. So there's a really interesting graph that I haven't included, but if the bars are open, people are playing video lottery. So this is an adjustment back to normal. And then the final adjustment, we're including recording fees, and there's a CAFA grant adjustment included in there. But both of those revenues are based on housing activity. There's a very hot housing market at the beginning of the year. That looks like it's already slowing down. We're seeing that in the data, but similar to the U.S. Marshal adjustment, we're just incorporating that big bump that we've already seen at the beginning of the year. So overall, we're changing the current forecast by $36.7 million, which at 6.41% is significantly higher than our 2% goal. If we want to go to the next slide, please. So we'll talk about property taxes here for a little bit. And so the red line is the real market value. The blue line in the middle is our assessed value. And then that orange line on the bottom is our level of compression. So what we've incorporated into the forecast and what I think looks like it's holding true is we've officially made it to the end of the last development cycle. And for a couple of years now, when you look at the Bureau of Development Service data, the permitting process had really dried up. So we knew we were headed to a significant decrease in our assessed value growth. So if you take out the River District adjustment this year, it was at 3%, which is quite a bit lower than it's been for years now. The red line is important to us because compression is based on the real market value of a property. You apply a percentage to that. So looking forward, a concern is that if there's a decrease in value, especially in like commercial properties and office space, things like that. It's not going to affect our assessed value revenue, but it could push up our compression. At this point, there's not strong evidence that that's happening significantly, but I think what we're discovering is, especially office space, it's going to take a couple of years to figure out kind of what is going to happen there. So people still have, or businesses still have long-term leases, and then I think a lot of businesses are still deciding what kind of their post-pandemic or endemic stage of COVID office space needs are. So this is something that we'll continue to watch very closely over the next few years, but I think it's just going to take a little while to play out. If we want to go to the next slide.
Can you
Oh,
pause for a second?
Yeah.
Go ahead.
A quick question, Jeff, on the last slide on compression. So am I reading this correctly to say that we lose about, I mean, is that billions on the left axis? Is that 30?
Oh, sorry. So the left axis for billions is for real market value and assessed value, and then the percentage on the right side is for compression.
Okay.
I should have been clearer about that. So we lose, I think it's about $14 million a year now. I can check that, but that's ballpark where we are. Yeah.
Thank you.
If we want to go to the next slide, please. So this is really kind of the bright spot in our property tax story, and this is what is going to sort of support our assumption that assessed value growth doesn't get to the sort of pre-pandemic heights anytime soon, but that we get back to sort of a normal level of growth. So this is year-over-year home price appreciation. This is the Case-Shiller index. The brighter blue line in the middle is Portland, and then the faded lines are Las Vegas, San Diego, San Francisco, and Seattle. So you can see during the pandemic, there was a big increase in home values really across the West. I think there's two things going on here. One is just a demographic driver here that would have happened without COVID. A lot of millennials are getting to their sort of root setting years. For millennials, it happens a little bit later than previous generations, but I think they're there now. So I think there's always been an assumption that millennials will sort of move out of their parents' homes or move out of their apartments and buy a single family house and have a family. That appears to be happening. The other issue is I think that, people realized during the pandemic that they wanted a bigger backyard and they wanted a home office. So there was, a movement to bigger houses. So what this means, and then there's an associated increase in rents. It looks like apartment rent growth is sort of coming back. This is what's going to fuel the next cycle of residential and multifamily housing development. So 2 weeks ago, there's a Bureau of Development Services advisory group that I'm a part of. And people were pretty confident that the next round of multifamily investment, we were going to start seeing that in the data pretty soon. So in a couple of years, we would expect to see a bunch of new multifamily value come online.
It's good news.
Good news. Yeah. Unfortunately, I think what motivates the cycle is, they're trying to time it for when the sort of price increases start to pinch. That's when kind of the new inventory comes online. It would be nicer if it was, a little smoother. If we want to go to the next slide, please. So we talked a lot about BIT just recently, so I just want to remind you of a couple of things. So the assumption that is incorporated into the forecast currently is that in fiscal year 2022, we have another year of growth relative to fiscal year 2021. And then we're assuming a decline in fiscal year 2023. On the next slide, I'm going to show you something that worries me and I think supports the argument for assuming a decline in fiscal year 2023. But in part, this is a risk hedging strategy. If we assume another year of growth in 2023, we could end up significantly sort of different than what ends up happening, and it would be really difficult to unwind that. So again, before we have to make any real decisions, we'll have another opportunity to update this and kind of see where the data is going. I can tell you what we're seeing right now is still an extremely high level of refunds that have continued into November. I'm working with the city revenue division to try to really dig into this data to see what we find. The other piece here, though, is that the really high level of refunds continues as our collections look pretty good. So in 2 slides, I'll show you that. But November, it looks like even I've never seen a level of refunds like this in November, but it looks like overall our net collections are going to be higher than they've been in several years. So it's still bizarre, and we're trying to figure it out. But ultimately, what we're trying to do with the BIT and thinking about this longer term is I always try to start with a sense of like, what are the underlying economic fundamentals telling us? So what is that trend that establishes? And then we talk about deviations from that trend caused by expectations that property transactions or some sort of like tax change. So I'll tell you, we're struggling at this point. And I say we, I guess I'm talking about me, but I'm talking about sort of the network of people that I sort of rely on to talk about this stuff. Between the federal tax reform and COVID, kind of like what is that clear signal? What is that underlying trend we're really trying to dig into? So if we want to go to the next slide, please. So this is the state economist included this in his presentation last week, and I thought it told a really striking story, so I've just stolen it. So this is corporate profits, U.S. corporate profits, and then that big increase in both the bottom part as well as the line shows an increase in corporate profits overall, as well as the percent of like the sales price that you pay that turns into profit for the company. You can see it looks really high right now. It's so high that I'm not sure that this is sustainable. So this is feeding into the pool of liability that our tax rate is applied to. So if we assume that this comes down to a normal level, I think that supports we're going to see a little decline as we get into fiscal year 2023. That being said, especially as the federal tax reform continues to play out, it is unclear how big the structural change associated with that is. So it is possible that this is just kind of the new normal. Maybe it doesn't stay at this level, but it doesn't come all the way back down. So I think that's the question that we're trying to answer here. But looking at this graph, and then this is kind of a analog to the corporate earnings graph I showed you about a month ago. This makes me very nervous and makes me think that we need to be a little bit more conservative in our assumptions. If we want to go to the next slide, please. So the last BIT one, this is cumulative collections by year. I've kept 21 in red just because it's so bizarre. And then the blue line on the left is 22 so far. It's really difficult to take anything from this right now, in part because in 2021, our collections were really affected by the wildfires and the smoke. So last year during this period was just kind of a throwaway period. And then the year before that, there was some really strange property transaction activity. So our collections are strong, is what I can say right now, even with the level of refunds that are going out the door. So it looks like for fiscal year 2022, assuming another year of growth, it seems to be a good assumption right now, but it's too early in the process to be extremely confident about that. You want to go to the next slide, please? So moving into motor vehicle rental tax. So this shows deplane passengers at the Portland airport. This is different than how I normally show you this data. We usually talk about year-over-year changes. But I set it up this way this time because it's pretty dramatic. So you see for the last couple of years during the summer, we would have 900,000 or more passengers deplaning in Portland. During the worst of the pandemic in April of 2020, we had about 40,000. So really significant decline. You see in the first summer of the pandemic, people starting to feel good and thinking that maybe things are going to go back to normal, and then another wave of the virus starting, and then people adjusting their behavior. And then on the right side, you see what is significant recovery, and we still have a ways to go, but we're at least in like the range of like what a bad month was in the past, where before we were sort of unimaginably terrible. The thing to note here, and this is where kind of the Portland specific reputational issues comes up. So Travel Portland, tracks airport activity, they track hotel vacancy, all of that stuff for a bunch of cities around the country. And really all of the other all of the other cities are kind of experiencing the same recovery. Ours is worse than just about everyone's. So we're coming back, but it seems like that kind of tourist travel to Portland is significantly lower than it was. Travel Portland will tell you there's just like not a ton of interest in having a convention here right now. So they're expecting it to take a few years before we get back to kind of a normal level of tourism and business activity here. In our forecast, we're also assuming that there's some types of business travel that just doesn't exist anymore. So even in the out years of the forecast, we never reconnect to the pre-pandemic trend. So this recovery and people coming to Portland is showing up in our motor vehicle rental tax data, and it's reflected in our assumption that we have a pretty significant recovery in 22 that gets even better in 23. But yeah, the Portland has some sort of unique struggles that are happening in other places, but here it seems to be a little bit worse. If we want to go to the next slide, please. So this shows our actual collections by year for motor vehicle rental tax. You can see that in 2021, we had almost a 50% decline in revenues. We were expecting something closer to 60%, so it's sort of good news, but a big decline. And then in 2022, we expect to be a little more than halfway back. We finally started seeing an improvement in revenues in this most recent spring, and then so far in the fall, it looks like that's going to continue. So this is a place where I think there is an opportunity for a little bit of faster improvement, but I think it's too early to say if we'll do better than halfway back or so this year. We want to go to the next slide, please. So when we put all this together, this is the slide I showed you at the beginning. Again, we have a $18.4 million surplus expected for fiscal year 2023 that grows to $40.4 million in fiscal year 2027. That line of red numbers in the middle, that is a portion of the BIT bump that we just went through. So this is the portion of it that we felt like there's an understanding amongst the county commissioners and the city council and the providers that are going to receive this money that this was an ongoing commitment. So we've incorporated this into our ongoing forecast. Again, the drivers here, it's really a story about increased property taxes due to the urban renewal areas returning their assessed value, and then fully incorporating the benefit of the BIT reform. We already have higher inflation built into everything in 23 and 24. And then I'll note that this doesn't include year 2 of our direct allocation of ARP funding. It also doesn't include any assumptions about if there's something we're funding with ARP that looks like it could become sort of the county's business going forward. That isn't reflected anywhere as well. I do want to note, we're going to talk about inflation in just a second. To give you a sense of the risk presented by inflation. So if in 24, 25, 26, and 27, I assume that inflation is 1% higher in each one of those years, by the time we get out to 2027, that would increase our expenses by about $15 million. So if the inflation we're experiencing right now is sustained, even at a lower level than what we're seeing like right now, we would be in a position where, you know, we could allocate the resources in 2023, and then by the time we get out there, the rest, that additional surplus we'd expect, would be eaten up basically by inflation. So it's a significant risk for us. If we want to go to the next slide. And we'll just move on. This is mostly here for reference if you want to check the detail on all of our revenue assumptions. Thank you. So getting into our assumptions around the cost side of things, and then this will start our conversation about inflation. So labor costs, we expect to increase by 4.32% this year. That the biggest chunk of that is a COLA assumption of 4%. The CPI measure that we use to calculate COLA is going to be higher than that, but our labor contracts cap our COLA at 4%. The other piece I want to talk about here is PERS, and we'll show a slide in a second, but our PERS rates are really made up of two pieces. One is the rates that we receive from the state that we just have to pay for participating in the system. The other portion is we have an internal PERS bond rate that we set. So we issued bonds years ago to reduce our PERS liability, and we have to make debt service payments on that. So we collect money internally to make those debt service payments. The PERS board decreased their assumption on assumed earnings going forward. So we actually expect on the PERS rate side an increase of 1.5% when we get to fiscal year 2024. So using our smoothing method, we're taking half of that increase in the current year. But then because we had higher COLA, we wanted to look for a place where we felt like we could offset these personnel costs. So we're reducing our internal PERS bond rate, which is why we have a negative adjustment there for PERS in total. And the reason for that is we feel like we have established a path we feel comfortable that we'll be able to continue to make our debt service payments going forward, and have a reasonable cushion, even with that reduced rate. So we think we can still act conservatively, but then provide ourselves a little bit of savings here to offset our higher COLA. Materials and services, our expectation is they increase by 4%, and that's the number that we're going to use as an inflation factor in our general fund allocation. I'll show you a slide that disaggregates the inflation numbers, but inflation is really being driven by a small number of factors. So we know that our departments, most of our departments aren't out buying used cars. They're not really, exposed to energy markets and things like that. So we don't want to give the headline inflation number for materials and services. We want to give something that we think is fair. This does mean that some departments who are more exposed to the higher inflation could come back to us and ask for an additional bump. That could be handled through the allocation, or it could come as an out-of-target offer. So we just want to say we're making an assumption here that we think is reasonable, but there are definitely places in the county where we'll hear more about this. One of those places is in internal services. So our assumption for the internal service rate increase is 5.33%. So that includes adjustments for some of those inflationary factors that we're talking about. So DCA does buy fuel. It's more expensive right now. There's also kind of a change in how the county does business. So as we've all shifted to remote learning, there's just software that we have to buy to help that process actually happen. Some of our software licensing fees have gone up. So because they start their process earlier, they came to us and demonstrated this higher level of inflation. So we've built that in. If we want to go to the next slide, please. So this shows inflation for both the US and then a combination of the Portland number that's been discontinued and then the West Size A number that we've moved to. So this isn't an unheard of level of inflation, at least that we're using in our assumptions here, but it is higher than what we've seen in the last few years. And interestingly, our inflation is higher than the US average, but right now we're a little bit lower than that. And I think a lot of that has to do with housing prices, our housing, which is one of our main drivers of inflation. Just because rents have been relatively flat recently, it's been a little bit lower. If we want to go to the next slide, please. So as with everything during COVID, the headline number is often misleading. So when you kind of dig into the data, there's usually all sorts of strange stuff going on. So this disaggregates the contributors to inflation right now. So the red portion is just due to vehicle sales, specifically used cars. The price has gone up really significantly. That was kind of the driver of inflation for a little bit. And then the blue portion are pandemic affected services. So when you think about airlines or hotels during kind of the worst of the pandemic, they slashed their prices to just get anyone to come stay at the hotel. So as those prices have gone back to normal, because inflation is a year-over-year measure, it looks like significant inflation when in fact it is just kind of a return to normal. So it is absolutely true that inflation is higher than it's been, and it has an impact on household budgets. It has an impact on how we do business, but it isn't broad-based yet. It's looking a little bit more broad-based as we go. But what we're waiting to see that would cause greater concern is if wages really start to react to this. So increases in wages tend to create this kind of self-reinforcing cycle that feeds future inflation. And then if there's significant inflation in energy prices, so really the price of gas ends up kind of flowing through to everything in the economy, which can cause broader based inflation. So things like more expensive used cars, more expensive refrigerators, while it does impact our, people's budgeting decisions in the present, those aren't really the types of things that cause us concern about long-term inflation. It's really kind of when the cycle gets going. I think there's some good evidence that some of the supply chain issues, especially around just like shipping goods around and manufacturing, things like processors that are kind of built into a lot of home appliances and stuff like that. It seems like those blockages are starting to ease. So we're starting to see things move through the ports a little bit easier. And surveys of people who like do purchasing for manufacturing, they're starting to see processors and like sort of the computer stuff that goes into appliances and things like that move a little bit freer. So that suggests that we may be close to peaking in our current round of inflation, but it is something to watch. If we want to go to the next slide, please. The other piece I want to highlight is another thing that's contributing to the higher headline inflation numbers is that the Bureau of Labor Statistics, when they do these calculations, they establish a basket of goods that they think is what like a typical household is buying. And then they have a process for changing that goods as purchasing decisions change, but it's just not designed to move very quickly. So we know that in the pandemic, there are really significant shifts in household purchasing patterns. So there's a professor at Harvard who used credit card data to create new household bundles, purchasing bundles based on what people are actually purchasing in the present. So the blue line is the official sort of CPI number. And then the, I'm not sure, peach and red lines are how you would calculate the CPI based on kind of how consumption has shifted during the pandemic. And you can see it's still higher than normal, but it's significantly lower than that headline CPI number. So, we use this as a measure to think about what's happening to households and kind of what they're experiencing. And I think between the fact that it's concentrated in some areas, and then also probably for most households, their consumption patterns have shifted, the underlying reality is probably not quite as dire as the headline would suggest, but still something to be aware of. If we want to go to the next slide, please. So this shows our PERS rates assumptions going forward. As you can see, post PERS reform, the combination of PERS reformed with the side accounts that we've established, we think that we've topped out on our PERS rates. The assumption around assumed earnings causes us to have one more increase that we've built into it, but then once we get past that, we're assuming we're flat. So going forward, we're really just subject to what's happening to the stock market and assumptions around stock market performance going forward. So we think we're generally in a good place. There's a lot of other jurisdictions, both locally and around the state, who are still dealing with year after year PERS increases, but we've been able to mitigate that through, I think, our policy of PERS smoothing and then establishing side accounts. We want to go to the next slide, please. So this and the next slide are the list of one-time only program offers in the current year. So I won't focus on any one thing here, but this is just to tell you that this is all stuff that we're doing right now that we're assuming doesn't continue into fiscal year 2023. So if you see anything on this list that you think needs to continue, then adjust our ongoing forecast accordingly. We want to go to the next slide, please. And then one more, please. So we're into kind of the housekeeping portion of the presentation. So these are assumptions for fiscal year 2023 one-time only funds. So as a reminder, fiscal year 2023 one-time only is made up of three different pieces. It's departmental underspending in 2021. It's how far off we were on our revenue expectations in 2021. and then changes we're making to the forecast in the current year. So the top portion is really driven by BIT above what we were expecting in 2021, which we've already allocated. So that $30.4 million in red that I've taken out there, we've already adjusted for that. And then departmental underspending in 2021 was about 3 times higher than what we typically see in a normal year. There's 3 reasons for that. There are 3 main reasons for that. One is that there was administrative accommodation for the health department for our CARES funding. So we were able to move a lot of what we had expected to fund with general fund and the health department over to CARES Act funding. Just there were capacity issues, in backfilling that. So the health department by itself had a level of underspending that's typically what the entire county has in the general fund. The other 2 pieces are personnel costs were lower than what we budgeted. We have a lot of vacancies at the county. The county is experiencing the same sort of labor issues that everyone is experiencing right now. And then the last piece is pass-through payments to third-party contractors was lower than what we budgeted. This doesn't mean that we weren't making those payments. A whole bunch of them were moved over to other funding sources, either state funding or CARES Act funding. And then it just didn't all get sort of backfilled in the general fund. So that as a starting point, then you add in the adjustments that we've already talked about at the beginning of the presentation. There's the big BIT adjustment in the current year. We back out the portion of that needs to be paid to East County cities according to our agreement. And then that 6.9 million is the rest of the adjustments in the year. Most of that is that property tax adjustment due to the River District URA coming back. That's $7.2 million in red. That is me taking a portion of one time only to make sure we maintain our reserves at the board policy level. This is the 2nd year in a row I'm doing this out in the open rather than sort of just handling it kind of behind the scenes. And it's because of the BIT increase and the URA increases. We're having these big jumps in revenue, so we have bigger jumps in our reserve requirements. So I'm just doing it out in the open so everyone can see it. The next 3 lines are italicized, and I want to start by saying what we're going to talk about is, of course, a board decision. But because we have a significant amount of one-time only available, Christian and Eric and I have been talking about ideas for kind of long-term county health stuff that we could think about doing. The first one is $25 million to establish an additional per site account. This is part of what we think has been a very successful strategy in managing our PERS liability. This is also a really good way to take some of this one-time only and convert it into an ongoing benefit. The next 2 numbers are additional amounts that we would add to both our general fund reserve and the BIT reserve if we wanted to increase our reserve percentage for both to 15% over the course of the next 5 years. So with this additional set aside, it would put us at 11% in both of these for fiscal year 2023. Eric is very good at talking about this, but basically our current level of reserves are fine. Increasingly, they are not sort of the gold standard of what a lot of governments are doing. And then the other piece is that rating agencies, I think, increasingly want to see a demonstration that we're returning to this issue. We're constantly evaluating if our reserves are at the right level. So between those 3 things, we think those are a few ideas for kind of the county long-term financial health that we could do now, given our large level of resources. And then even after that, you would still have a significant amount of one-time only to allocate. The $3 million of one-time only that we use to balance. I meant to talk about this on the 5-year slide, but I briefed all of you on this. So we have a decline in the surplus in fiscal year 2024. It's really our structural deficit kind of reemerging for 1 year because we don't have another URA coming back that year. In 2023, we've already incorporated the BIT reform adjustments. So we have normal revenue growth and a little bit faster than normal expense growth due to the assumption of higher inflation continuing into 2024. So what that means is if we allocated all of our 23 surplus as ongoing, then we'd immediately have to cut some of that in 2024. So the way that we normally handle that is we would take anything above what we thought we could sustain into 2024 and beyond, and we would count that as one time only. So that's the adjustment there. I do want to say, given that the amount of one time only that we have available and that the gap is well within our forecaster, we have some tools available to us to mitigate this. But I just want to highlight there, and it'll be part of our ongoing discussion in the budget process. So if you assume that $3 million is one time only, we would have $46.6 million to allocate in 2023. By board policy, we'd split that in two. We'd have $23.3 million for capital and 23.3 to be allocated otherwise. We want to go to the next slide, please. So this is the contingency update for the current year. We still have the $1.5 million of normal contingency that we've set aside. We still have $1 million of the state funding ramp down and sort of unknowns, that additional contingency that we established. And then that $423,000 of additional contingency, that comes largely from additional central indirect that we expect as part of the Fed state rebalance process that we went through recently. So overall, there's $2.7 million of unearmarked contingency available. We're going to go to the next slide, please. We're getting close to the end, and these risks and uncertainties that we've listed here, we've talked about most of this, but I'll just reiterate that COVID-19 is still, we're still dealing with it. It's still kind of driving a lot of the economic decisions, both at a macro and a micro level, which has an impact on both our revenues and the demand for county services. The economic recovery is going to be driven by the way that we continue to deal with COVID. Additional issues that we'll continue to track are kind of the Portland specific issues related to economic recovery, as well as, you know, both internally at the county, but then also for downtown and office space and beyond. The way that people return to work, kind of what the future of office usage and work at home looks like, has implications for our property tax revenue over the long term, as well as potentially our BIT. We already talked about potential impacts from federal legislation on the BIT. And then for personnel costs, we have 7 open labor contracts right now. One of them is Local 88, which by itself is about 60% of our workforce. So there's opportunities there to have changes and expense expectations going forward. We want to go to the last slide, please. So just a quick summary of the most important points. So for the current year, we're increasing the budget by $36.7 million. You still have a general fund unearmarked contingency of $2.7 million. In 23, we expect a surplus of $18.4 million that will grow to $40.4 by the time we get to 2027. Significant amount of one-time only resources available at $46.6 million. And then COVID and inflation are what we're tracking, along with a bunch of other things. So with that, I'll stop talking, and Christian and I would be happy to answer any questions that you have.
Thank you. As always, very thorough. Appreciate you, Jeff, and you, Christian, and your teams. All right, commissioners, questions, comments. Commissioner Myron.
Thank you so much, Jeff. That was an incredible, comprehensive, clear, concise description of what's going on. And I appreciated your talking to me about it previously. And it's so great to have you presenting here in person. It's maybe even more amazing to hear it in person. But this is really exciting to even be thinking in terms of having that kind of revenue coming in, but there are so many complexities and of course so many just unprecedented or unique factors coming into play. It'll be interesting to continue watching this, but I don't have any questions right now. Thank you.
Commissioner Jayapal.
Thank you, Chair. Thank you, Jeff. thank you for the briefing you gave me last week. And Christian and I think, managed to make you blush, or at least make your forehead blush, because that's all we could see. And I think it's happening again. I just so appreciate the quality of this work and of your briefings. Commissioner Myron said both comprehensive and concise. I'm not quite sure how you managed to do that, but you do. But the clarity and the context that you provide, I mean, you could give us the top line numbers without giving us the context, and I think we'd be missing a lot. So I really, really appreciate the quality of the context that you provide. And also appreciate the whole team, Christian, Jeff, Eric, the thoughtfulness with which you approach making sure that we're keeping an eye on the long-term fiscal health of the county. I mean, that at the end of the day, that is what we are tasked with as well, and you make our jobs easy in that respect. So thank you very much for all of that. I guess echoing what Commissioner Myron said, it's kind of extraordinary. I mean, these numbers are extraordinary. The combination of uncertainty, risk, and yet top line growth and revenue is extraordinary. I do feel like when we look at that 2027 forecast, there's an opportunity and a responsibility to think about how to approach that strategically, not just continuing to grow all of these great programs, but what are the structural issues that we might be able to address with that revenue? And one of the things I think about is our contracting workforce and the need to figure out how we compensate that workforce. And I know there's a work group on that, and it's something that we need to prepare for now, because 2027 isn't that far away in order to address something that big. So I'm just looking forward to what we learn from that work group and being able to start to think about that pretty quickly. One very quick small question on the increasing the reserves to 15% over time, which sounds great. We should be the gold standard. We're doing it out of one-time revenue this year, one-time resources. But I'm assuming that if we're planning sort of a glide path to that over the next 5 years, it's going to be out of ongoing in the next several years.
This is Jeff Renfro responding. So we could think about it different ways. So I mean, one of the benefits of just doing it kind of 1% at a time is we could make these jumps when we feel like we have the one-time resources available to do it. Another way to do it would be to just say, we're getting there no matter what, and we could put an ongoing set aside and basically just prepay for it. So I think it should be kind of part of our discussion about how exactly we want to handle this.
Yeah, great. Well, thank you. Really appreciate it.
Commissioner Vega-Peterson.
Thank you, Chair. Thank you so much, Christian and Jeff. My colleagues have already said like all of the wonderful words, but I just can't. I think we are the most well-informed board in the state when it comes to some of these things. And really having heard a lot of these presentations when I was on the revenue committee in the legislature, like this is absolutely, the information we get, the way that you put it in context and how it relates to the county and the decisions that we're going to have in front of us as a board, it's just incredible. And I just appreciate it so much, all of the work that goes into this. This is really incredible news, and it's gives us a lot to think about as we're looking at this budget period, but also like looking at future budgets and thinking about that, and how we're going to do that. The slide that I always, love to pay attention to, though, is the forecast risks, uncertainties, and issues, because usually that's where all the problem, all of the open things that we just don't know and can't really fit easily into the presentation, go into effect. And I think, how the federal legislation and federal tax policy is going to impact what we're seeing locally on the ground is going to be something that I'm really interested in seeing how that turns around, as well as other internal things like our open contracts and things. But overall, I do think it's, positive news, it's good news, and it's gives us a lot to think about. I also really appreciate the very specific recommendations that you give us in terms of making good, thoughtful and financially responsible decisions that we could do with some of the money that we have this time around for the long-term health of our of the county. And I think that that kind of advice in the past has led us to the position we find ourselves in, for instance, with the PERS account, and where we are not seeing great increases. So I just appreciate that. The one question I had was on the summary slide. The general fund revenue forecast increase of the 36.7 million, that isn't including the 30 million that we've just already allocated for the BIT. That's in addition to that, correct?
That's correct. So that's only the 22 changes.
Yep. Okay. All right. That's good to know. I didn't have any other questions, but just thanks so much as always for your great advice.
Commissioner Stegman?
Thank you, Chair. Thank you, Jeff, and thank you so much to the entire team. Jeff, I did have a couple of questions. So I was wondering, on the BIT, do you have an idea of how much of that increase was attributed just to the BIT reform versus just the unanticipated growth?
Yeah, that's a great question. And I think so from our perspective and the city's perspective, what we ended up collecting in 2021 basically matched our pre-pandemic expectation. So our interpretation has been based on federal support. We basically just didn't have a recession for these revenues. Either interesting or terrifying counterpoint to this is at the state level, their corporate taxes year over year went up by 44%, which is more than ours did, and we had a rate increase built into that. So at the state level, they far exceeded even their pre-pandemic expectations, and so it's a different tax. So it makes sense that we're different sometimes, but for us to be for our actual collections, not just kind of our expectation for the future, but for the actual collections to be that far off is really strange. So actually next week, the city economist and the state economist and I are all getting together to have sort of a business tax summit to try to suss this out. But I don't know. I feel like that is the question: is what is the deviation from what we would expect the sort of underlying fundamentals to support, and what is the portion of it that is like just some weird quirk that's happening on top of that? And like with everything in COVID, we're getting conflicting signals and conflicting messages. So.
Well, thank you, Jeff. I'll look forward to hearing more as you suss that out. And then I had another question, and I don't know if you'll be able to answer it, but you had mentioned that you felt like rents were going to be going up. And I'm wondering, do we have an idea of are vacancies up, down, leveling off? I'm just kind of wondering, do we have an idea of where the rental market is going?
So on the vacancy rate, I don't remember what it is right now, and I can look that up and send it to you. But I do know the rent or the eviction moratorium has kind of messed up that data stream. So kind of what we normally take, kind of the signal we take from that. I don't know what exactly it means at this point. So as great as that policy was and necessary, it is messed up a data source that economists look at. So I can tell you based on what I'm just hearing from people who follow this closely, and I think what people in the development community are saying is that just we took kind of a pause on building multifamily stuff over the last couple of years, and just based on normal population growth in the metro area, we need to start building this again. So maybe we don't have a shortage of as dire as there was coming out of the financial crisis, where just nothing was built for several years. But that kind of normal, more people move in, there's less multifamily housing available, rents start to go up, and then more capacity comes on. It seems like we're at kind of the bottom of that portion of the cycle. So something that I almost never talk about here, but we could start talking about is just the impact of population growth on especially our property tax assumptions. And I think it's going to be dictated by, so the Portland metro area is still growing, and it's still growing at a pretty good rate. It seems like Multnomah County specifically is maybe slowing down a little bit, and a lot of the growth in the Portland metro area is across the river in Clark County. So for us, kind of the specifics of how that plays out over the next couple of years as people start moving again, which they just haven't done during the pandemic, of where specifically they settle within the Portland metro area is going to be something that will impact us.
Great. Thank you so much, Jeff. I agree with my colleagues. You do such a phenomenal job of taking very complex economic issues and breaking them down for us. And I appreciate the prudent recommendations of putting aside whether it's money into the per site account or the BIT savings account or general fund. I obviously that's why where we are today. And I think that we're in a pretty good financial standing because of the policies that this board and that you all have educated us enough to make really great decisions to protect our standing, our good, excellent financial standing. So my hat's off to all of you. Thank you so much.
All right, thank you. Thank you, thank you. That's the end of our agenda for this morning. I do have two announcements before we leave, though. First of all, I want to congratulate one of our county employees, Sylvia Tanner from the Office of Sustainability, for being included in the Northwest Energy Coalition's 4 under 40, not 40 under 40, 4 under 40 list. So Sylvia is deserving of this recognition for so many reasons, but what I especially want to draw attention to is her dedication to a transition to renewable energy that is undeniably and fundamentally justice-centered. She is a tremendous asset to Multnomah County and to the communities we serve, and it's wonderful to see her being recognized in this way. And second of all, I know we do not have a board meeting on Thursday because it's Thanksgiving, but it is also Kim Melton's birthday. Kim is not in the audience today. She hopefully is listening to this, and we are embarrassing her in a good way. But everyone, I know around my Thanksgiving dinner table, I'm going to give thanks to Kim Melton. She is such an asset to our community and to our county. So happy birthday, Kim. And with that, we do not have a board meeting, obviously, on Thursday, so we will be back here next Tuesday, the 30th of November. And until then, have a lovely holiday weekend. Stay safe and stay healthy. And we're adjourned.